Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
This podcast was recorded on June 8th, 2020.
Good morning again. A lot to talk about. Financial markets, specifically U.S. equity markets, continue to move significantly higher. So a lot to talk about. Stock market, bond market, U.S. market, international markets, U.S.-China relations. Lots of news with protests ongoing here in the United States. And we'll discuss all of that this morning. Before we get started, going to talk about, number one, talk about reminders based on the Secure Act and the CARES Act, some of the things that are important to think about as a result of those recent legislation changes. We've talked about that before. Then I'm going to talk about how to reset our mindset and get back on a path if we've skewed off a path of optimization or how we go about our day in the uncertainty and the significant changes that took place in all our lives with the coronavirus. And then I'm going to talk about some ideas from Barron's and then turn things over to Brad for some further insights on the markets. So to get started this morning, I want to reiterate and remind investors, clients that IRA distributions this year are not required in most instances to be taken. There are a handful of instances where they are required, but in most instances, IRA distributions are not required. So conversations with clients, if you're an investor, make a decision on whether or not it makes sense for you to take a required minimum distribution because it is not required in most instances. Obviously, if you take a distribution, you will have to pay tax on that distribution, and not taking that distribution, potentially, depending on your bracket, may make more sense from a tax standpoint, but if the cash flow is needed, then the distribution still certainly would make sense to maintain lifestyle. But important conversations to have. Reminder that RMDs now begin at 72. They used to begin at 70 and a half. Stretch IRAs are no longer permitted to the children of IRA owners, no longer permitted to be taken over their lifetimes, now must be taken out over 10 years. So this could have a significant effect on estate planning. Many estate plans were set up with the intention that big assets in retirement accounts would be distributed over a child's lifetime or multiple children's lifetime. No longer the case. This opens the door to possible conversations about better solutions. Some of those solutions may involve insurance, depending upon the health of the person who has the assets or the people who have the assets of a couple. So alternative solutions may make sense given changes in the legislation. And that's just the tip of the iceberg. I want to remind everyone to read the bullet points about the Secure Act, about the CARES Act, and the changes that those legislative pieces have had. Another great example of why it is important if you're an individual investor and you are not in the business of following the financial news and the changes in legislation on a day-to-day basis, working with an advisor. That is a significant value add. If the advisor is providing those valuable insights to you, that advice can, in some cases, more than pay for itself. And to rely on someone else to be able to be that second set of eyes is something that could be of value. So I was just talking earlier, I was saying we're going to talk about good habits and how to get back on track. If you're not on track, some may very well be on track and never lost track. But many of us in the corona lockdown have either changed hours, changed situation, perhaps working from home, and perhaps some of the routines or habits that had been set in place that some of us worked very hard to build over the last few years got derailed, and want to think about, well, how can we change our habits, perhaps back to the way they were, or perhaps they were not where we wanted them to be before. That's perhaps even more likely the case. And what can we do to change our habits, to make our habits something that can be super productive? And one thing to focus on when you think about habits, and this comes from a book by James Clear called Atomic Habits, is many of us in our minds think of habits as goals. So in our minds, we think to ourselves, I am going to set XYZ goal. I'm going to lose XYZ weight. I'm going to, if I'm a salesperson, I'm going to open up XYZ new relationships, or I'm going to do XYZ in sales, or I'm going to have some other metric where I'm going to measure my success. And setting goals that focus on results can oftentimes not lead to the outcome that we desire. Because if you think about setting goals, whether or not you're an investor or an athlete, those who succeed in their goals probably had the same goals in mind as those who failed. So if you're a failed athlete or a failed investor, the goal-setting process is not what sets us apart. It's very likely that those who succeeded and those who failed had very similar goals in most cases of what that end result looked like. And the reason for that lack of success and what differentiates those who achieve their goals from those who don't is not the goal-setting process in most cases. Obviously, if you're not setting goals, perhaps that's the first criteria to consider. But in many cases, many of us have New Year's resolutions. We have goals that we set for ourselves quietly amongst ourselves, but many times we come up short. And the reason that we come up short, and the reason those who succeed is separated from those who fail, comes down to the processes that help us achieve our goals. So perhaps your goal is to have better client relationships. If you're an advisor, a therapist, whatever your business is, and your goal is to have better relationships, and those better relationships will therefore lead to better outcomes, will lead to potentially more relationships, and therefore to financial success and perhaps personal success, and being happy that you're helping your clients succeed in whatever business that you're in. So the goal is obvious, but the process is what needs to be focused on. So, for example, perhaps the process is I need to get up earlier to start my day on time. I shouldn't be strolling into my home office, my personal office, or beginning my day talking to my clients, whatever the situation is. I need to do that earlier. So first off, the mentality is, okay, well, I need to get up earlier. But getting up earlier in of itself is the result of actions that you need to take even before the morning. So number one, perhaps you need to think, hey, I need to go to sleep earlier. Hey, I may need to stop drinking coffee at noon. I may need to not have a late dinner, or perhaps I may need to take maybe I need to have a much lighter dinner. Perhaps I need to take a shower before I go to sleep to help me relax, whatever the situation is for the individual personally. And finally, I need to set my alarm clock for the hour that is necessarily for me to begin that process. So all those steps must be in place. It's not simply just waking up earlier. It's not just setting the goal of I want to do better. I want to do these factors better. Thinking about that, James Clear in his book pointed out the importance of setting up those processes, and he pointed out that you do not rise to the level of your goals, you fall to the level of your systems. And I talked about goals, I talked about processes or systems, and finally the third layer of thinking on changing habits is your identity. Your identity is your self-image, your worldview. And the more you repeat a behavior, the more you reinforce the identity associated with that behavior. if you think to yourself, I am a person who is healthy, I am a person who is a good investment manager, I am a person who offers valuable advice, I am a person who loves poetry, you fill in the blank. If you start creating that identity, you start creating goals and then hopefully processes and habits to meet that identity. And you may say to yourself, well, right now that's all where I'd like to be, but I am not there right now, so how can that be my identity? And this is where the thought process is that you do, in some cases, need to fake it until you make it. So if you're overweight and right now you can barely walk up a flight of stairs, you're faking it if you're telling yourself that you're a healthy person. However, once you embody the behavior of a healthy person, start losing weight, it will be easier to convince yourself that you're healthy once you get to 280 pounds, 250 pounds, 235 pounds, and you're moving around with greater ease. So, things to think about: goals, processes, systems, identity, on how to make some changes and to make your life hopefully more meaningful and more productive on multiple levels. All right, moving on to markets this morning. We have a continuation of what took place at the end of last week, which is a market rebound, especially a rebound in what would be considered recovery stocks, value stocks, cyclical stocks, stocks that benefit from the economy reopening. So we're seeing Dow futures up about 270 points, S&P futures are up 23, and NASDAQ futures, which represent some more of the growth companies, down 2 points. So we see this rotation that we saw at the end of the last week continuing. Also, this morning, we see in that recovery space, we see stocks like Boeing, which was upgraded this morning. Someone put a $277 target on it. It's up about 17 points. So airline stocks, casino stocks, bank stocks leading this morning in the pre-market action. Also, we had news over the weekend that AstraZeneca, AZN, had approached Gilead, GILD, about a potential merger. Gilead has not yet formally commented on that. This morning, Gilead's up about $3 per share, as this would represent, if it were to happen, and again, it's far from happening at this point, but if it were to happen, it would be the largest pharmaceutical deal. It would exceed the deal which was the acquisition of Celgene, which was about a $70 billion deal. This would be close to a $100 billion deal. Oil this morning down slightly, down about 30 cents a barrel. And taking a look at treasuries, which Brad sure will give us some more insights into. But treasury yields this morning are moving slightly higher, actually. They were up a little bit more earlier, but basically actually relatively unchanged to slightly higher. The 30 years up about a basis point. The 10-year just up nominally. Actually, the 2 years yield is down nominally. So give you some perspective, the 3-month is yielding 16 basis points, the 10-year is 90 basis points, and the 30-year is yielding 1.69 this morning. Gold is up $12 an ounce this morning, and the dollar this morning is also relatively flat after weakening last week. Some other news this morning, the Fed is considering buying enough treasuries to peg yields at low levels. According to the Wall Street Journal, this is as yields have moved up in the last few days, albeit still very low by historical standards. OPEC has agreed to extend the phase of the production adjustments that they had agreed to, and they are agreeing to extend those for 1 month. New York City is beginning a first phase of reopening with construction and manufacturing. UK Prime Minister Boris Johnson said he aims to quickly lift lockdown restrictions. ABC News is reporting that satellite data from researchers suggests that the coronavirus may have been spreading through China before it was reported to the world. Apple in the news saying they will allow customers to purchase certain products with monthly installment payments, zero interest, if they use the Apple credit card. Facebook CEO Mark Zuckerberg is telling employees that the company will review its policies on political posts after he had gotten lots of pushback from employees with respect to Facebook's policies after his comments after Twitter put some warnings on President Trump's tweets, and Facebook said they would not take any action, and now they say they're reviewing that. Also, some Chinese companies are listing their shares outside the United States as concerns grow for them that the U.S. May no longer allow Chinese companies to list unless they conform to U.S. GAAP accounting. So JD.com is launching a Hong Kong initial public offering. NetEase is doing a global offering, which includes a Hong Kong offering as well there. Some analyst comments this morning. We have a downgrade of Penn National Gaming, symbol PENN. Deutsche Bank cutting it to sell, putting a target of 22 on the stock. In the airline space, JetBlue was upgraded to outperform from market perform at Bank of America Merrill Lynch. Barclays initiating coverage with Moderna mRNA with an overweight rating there for that stock. So moving on to Barron's. Barron's ran an article entitled "The Stock Market is Always Right." They point out that many of us had been discussing that there was a large disconnect between the market and the economy, and Barron's suggesting that perhaps there wasn't as much of a disconnect as expected. After Friday, we learned that the U.S. economy added 2.5 million jobs in May. It was expected to see job losses of about 8 million. Unemployment rate, which was expected to tick up to close to 20%, actually came in at 13.3%. To say the number was a surprise understates just how unexpected the good news was to everyone but the stock market, which has been telling us that good news was coming. Clearly, the equity market sniffed out the recovery ahead of its pace. It is easy to forget that the stock market is a leading indicator. It starts to respond before we get data. That's perhaps why the S&P was already in free fall when the WHO declared a pandemic on March 11th and started to rise as the headlines got worse. Barron's does point out that they believe that the stock market is still expecting some further developments out of Washington, and that therefore there are some risks if they don't come to fruition. First off, they think that the market is pricing in to some extent a new stimulus bill, something that hasn't passed and seems to be caught up in partisan politics. And also, market's going to be carefully watching what the Federal Reserve has to say this week. If the Fed were to dial back in response to some of this positive economic news, if the Fed were to dial back some of their response, some concerns on how the market would react to that. In a separate article, Barron's said, when both bulls and bears make sense, what to do. They say the S&P 500 has bounced back almost to flat for the year, even amid the corona pandemic. Trade tensions with China, nationwide civil unrest, barring a city-sized meteor strike striking the Earth, the index could hit a new high by the end of the year. But they point out that if the meteor strike were to happen even before the end of the year, we might get a rally even earlier. Sort of being facetious, suggesting that good news is good news, and right now bad news is good news. They point out that some of the good news is the result of the policies by the Fed and Congress and the Trump administration. The Federal Reserve is going to spend close to 40% of GDP to offset the pandemic effects, and if we get further stimulus from Congress, they could add another 35% of GDP stimulus programs. At the same time, consumers who have been forced into saving during the shutdown and are now armed with low borrowing costs could potentially bounce back quickly once spending opportunities resume. Bank of America now saying that GDP could have somewhat of a V-shaped recovery, something that many had been suggesting was impossible if the situation continues on its current course. Speaking about some of the effects of the coronavirus in the same article about what to do, Robert Shiller from Yale University, Nobel laureate who studies long-term trends and valuations of stocks and houses, Also opines in talking about valuations of homes in the suburbs, and expecting suburban real estate to outperform real estate in city centers for the near term. Moving on to a couple of stocks mentioned in Barron's. Barron's spoke positively about GlaxoSmithKline, symbol GSK, pointing out that they have some developments that they feel aren't factored into its stock. They say perhaps the most promising development is its trial of a drug that is a regular injection to prevent HIV infection. That trial has been stopped 3 years early because of how successful it was. Tests show it to be 69% more effective than the current gold standard, which is a drug from Gilead. The market for HIV prevention currently is a $2 billion opportunity, and it's expected to grow to a $5.5 billion opportunity by 2030. GlaxoSmithKline also looks set to unlock some value in other ways. It's undergoing a restructuring. They are spinning off their consumer healthcare division that makes Advil, and they have a strong pipeline of potential blockbusters on the way. Glaxo is the UK's fifth largest firm, market value of about $104 billion, employs 100,000 people. The company sells at about a 14-time expected earnings, which is a 30% discount to its peers. Also offers a dividend yield north of 4%, and they feel that the dividend yield and the risk-reward of the stock at this point could make an attractive entry point. Sticking to the drug stock theme, Barron's talked about antibody drugs that could help curb the pandemic, and they talk about 3 different companies that are working on antibody drugs, and they suggest that antibody drugs, while they don't hold out the promise of eliminating the threat of COVID-19 in the way a vaccine would, the new antibodies could help curb the pandemic. The drugs might be able to treat patients who are not yet in the most advanced phase of the disease, and they also may offer short-term like immunity. They also may be able to prevent infection on people who have been exposed but not fallen ill. What's more, unlike vaccines under development, the technology behind the antibody therapies is well established, and the safety risks are thought to be low. Some of the best-selling drugs in the world are monoclonal antibodies and are manufactured using some of the same techniques that would be used to make an antibody to treat COVID-19. So 3 new programs have begun in humans, one by Eli Lilly, which announced on June 1st that it had begun a testing process, a phase 1 trial. The other is by Regeneron. Lilly is LLY. Regeneron is RGN. Regeneron is set to begin testing this month. And finally, there's a collaboration between Vert Biotechnology, symbol VIR, and GlaxoSmithKline, who we just spoke about, GSK, and those trials also will be beginning this summer. Ver is perhaps the most pure play, highest risk, highest return play in the monoclonal antibody space. It's got a market cap of about $3.9 billion. And does have a potential pipeline of some viral antibody drugs to treat COVID and other illnesses, but also critically important to point out that currently Ver does not have any revenues, VIR. Last stock I'll talk about was the cover story of Barron's, and it is Twitter, TWTR. Barron's writing positively about Twitter, despite the fact of pointing out that Twitter has underperformed the broad market and rivals like Facebook and Snap. Over the past year, Twitter is down 3%, 37% gain for Facebook over that time, 13% rise for the S&P 500. But Barron's suggesting that there are signs of a turnaround at Twitter. For investors able to stomach the ongoing political debate, Twitter could bring substantial gains in the years ahead. Most analysts still rate Twitter shares at a hold. In March, 2 fund managers pushed their way onto the Twitter board. Twitter was hit harder in terms of advertising revenue than its peers because so many of Twitter's ad campaigns are driven by sports events, concerts, and product launches. But the flip side to that negative is it also makes Twitter a play on the economy's grand reopening. amid the spat between the Trump administration and Twitter last week, the story of any kind of news or any kind of fame being good news. Twitter on Wednesday had its largest one day ever in terms of downloads of the Twitter app, 677,000 downloads on Wednesday of last week. Also last week, Twitter set a record for daily active users, 40 million people using the app in the United States. So as the controversy envelops the company, the users have been increasing. Again, the contrarian mindset analysts mentioned aren't enthralled with the stock. 43 analysts cover it, 9 buys. Average price target is 30, which is 14% below the recent price. But Barron's suggesting that low expectations can lead to the kind of surprises that drive stocks higher. And Twitter has two positives going for it. One is the business metrics, which we just discussed. And second is the activist investors who, if the business itself doesn't drive the stock performance price higher, the activist investors could well potentially push out Jack Dorsey, who's the CEO, and his team, and perhaps install a new team, or perhaps push hard for a merger or acquisition. Big difference between Twitter and some of its rivals is that Jack Dorsey only owns and controls 2% of the stock. So different than a situation like at Facebook where Mark Zuckerberg controls the voting stock. That is not the case at Twitter, making change significantly easier than at some other companies. Turn it over to Brad. Good morning, Brad.
Hey, Keith. How are you? Great to have you back. Hope everyone had a good weekend. And just want to start by saying that the last 3 months have been a tidal wave, not only in the markets but also emotionally. And it's good to get outside on a beautiful June day and feel like things are getting back to normal a little bit. But the lesson that I learned, again, and I learn it every time we have something like this, you can never be too scared or too proud, because if you are, you get hurt on both sides of the trade. So the answer is always stay the course, stay your own course, and stay the course that your clients ask you to stay, and have a game plan so that when this happens again, which it will, it may not be the same exact scenario, but there's thought going into what if situation. Last week, for the first time, the Treasury market, longer-term Treasuries had a pretty significant sell-off. You had the 10-year Treasury going from 0.7 to 0.9, the new 20-year Treasury going from 120 to 145, and the 30-year Treasury going from about 145 to 170. That was a very big move in terms of percentage basis. And for the first time, I saw long-term municipals trade cheaper with the move in treasuries. There had been a complete disconnect from all spread bond markets and treasuries. Treasuries were just in their own world. So what I would like to suggest is that keep an eye on these 20 and 30-year treasuries and where they're going. I know that Keith said that the stock market is a leading indicator, and it is. But historically, the bond market even at times leads before the equity market, and you get an international sentiment of what people think when watching these longer-term bonds and where they're moving. If we were to use the equity market as a guide for what I think the next move in municipals would be, if this is truly getting into recovery mode, I think that we can start looking at what I'll call level 2 municipals. They don't have to necessarily be the AAA bonds. I would consider starting to look at bonds that have been put on credit watch that will survive, similar to the second-tier equities that are going to survive. So what are those? Maybe a Port Authority of New York and New Jersey, or a Triborough Bridge, a New Jersey Turnpike, a Connecticut special tax, and bonds like that around the nation that revenues are going to be saved because corporations and industries have been saved. As if, for instance, the Port Authority is highly dependent on airlines paying revenues for their hangars. So now that the airlines seem to be in a better place, the Port Authority will be getting more of the revenue. And I would still keep in mind what was in trouble before the COVID, and what was and wasn't working before, and the federal stimulus will help those in the short term. And like similar with the equities, the ones that were the most beat up have bounced back the most. But at the end of the day, you have to really take a look and see if this is just short-term stimulus that is helping these bonds, or is there a real long-term story, or are you going to go and experience during whatever the next crisis is? Are you going to experience what we experienced 2 months ago? Municipals are still very cheap relative to treasuries, especially in that 15 to 20-year range. I mean, we're looking at yields to call of 200 to 300% of treasuries, and it's just crazy. That being said, of course, we're still at very low, absolute low rates, so you have to keep that in mind too. I always like opportunities to upgrade portfolios, and now that some of the lower grade credits have had this uptick with federal stimulus, it may be a good time to review this again, so you're not reviewing it when we hit rock bottom and at a point where we're scared. You want to make these trades from strength, not weakness. The last thing I'm going to say is, please don't get complacent. The story's not over. I'm not saying the ending will be good or bad, because we have no idea. Just always expect the unexpected. And I wish I had a crystal ball, and I'm sure we all do. But we'll all work through these volatile times together. And that's all for today.
Thank you, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.